Are we finally seeing growth in the economy? More importantly, are there structural issues that could cause the growth to slow down? We're going to talk about that today in Strategic Equity Management's fourth quarter economic update. My name is Jeff Hybiak, and I'm the Portfolio Manager for Strategic Equity Management. I'm very grateful that you've taken some time to listen in, and we're going to try to make this as quickly as possible and give you information that you can use. It's one of my more exciting times to actually do one of these updates because we've kind of seen lackluster growth in the economy, and we started predicting, sometime late spring or early summer that we would see growth approaching 3%. And during the third quarter of 2013, we finally saw 3% growth. And now, as we're going forward, we're starting to see a lot of our economic indicators show that maybe that growth can continue. So let's really jump in and talk about strategic equities' leading economic indicators. I've summarized them up there on the screen for you. And as it says there in red, all of our indicators, if you look at where they're at now and what that's meant historically, we're looking at an economy that could grow around 3.1% throughout 2014. And there are 5 economic indicators that are actually showing stronger growth than that. You want to look at consumer goods orders, stock prices. Obviously, we've seen the year that they've had in 2013. They're pointing to 3 to 5% GDP growth. Building permits, hours worked, as well as the order backlog are all showing very strong signs of strength. So those are indicators we're going to watch into next year to make sure that they continue to show strength, because they are really dragging the economy along. Some of the indicators that are really right in the middle, payrolls and supplier deliveries, have shown improvement as far as payrolls have gone. Supplier deliveries also have picked up over the recent few months. So the things we want to look at, though, that are the 3 that are below trend growth, and that is capacity utilization and business activity. Now, we're actually going to talk about capacity utilization and why that's an issue in the big picture. But what we've seen right now is it's just not improving enough to show signs of strength. And I think the bigger concern is if you look at consumer confidence and the fall off it's had over the last few months, it's actually showing an economy that is what I call at stall speed, where it's barely growing at 1%. So if too many of those indicators start to pull down the economy, we could be into some trouble. But as it is now, we're looking at growth about 3.1%. That is probably near the bottom end of what some Wall Street economists are expecting for 2014, which is fine by me because we were actually above what most Wall Street economists were expecting, and we were proven right throughout 2013 as far as our growth predictions went. If you want to look at GDP growth, as I mentioned in the lead-in, we finally saw very strong economic growth in the third quarter. It was actually 3.6% under the latest revision, which was nice because that's the 5th time out of the 17 quarters that we've been in a recovery that we've seen growth above the long-term average, which is right about 3.1, 3.2%. And so the question really becomes, is this something that can continue? And I think, as I said when I started the year, the key to that is going to be housing. And I went ahead and put up one of my favorite slides here. And this looks at housing starts, which is how many homes are seeing the ground broken on, versus the economy. Now, if you look at the economy in red and housing starts in blue, you can see that generally they tend to go up and down together. Now, there's some people that say, well, the economy causes housing starts to go up, and others that say, no, housing starts cause the economy to go up. I really believe that it's a mixture of both. But as we've seen throughout this recovery, as long as housing has been tracking higher, GDP growth has been tracking higher. Now, I zoomed in a little bit to look at this from 2000 on, because you can see there is some noise in the numbers, but you can also see still in general, that blue line and red line tends to track each other. Sometimes housing pulls the economy down, sometimes we see housing just show a month or 2 lag. Now, what you can see there at the very end of that chart is we see housing starting to drop as far as growth goes, where GDP has picked up. Unfortunately, we don't have the numbers for September, October, and November yet. We will get those the week of December 16th, I believe, and those were delayed because of the government shutdown. So we'll be really curious to see, did that pick up? Now, the reason we'll be so curious is we saw interest rates over the summer when we saw this drop in housing starts really creep up. The 10-year bond almost hit 3% for a while, and that did cause a slowdown in housing starts. And so the question will be, now that interest rates relaxed some going into the fall, did we see a boost in housing starts? If so, I think that's really good news for the economy. If not, I think that's going to be an issue, because the other thing that can really impact our growth going forward is going to be what the Fed does with their quantitative easing program. Now, when we saw interest rates spike up, both in May and in August, we saw the reason behind that was because the Federal Reserve was hinting very strongly that they were going to slow down their asset purchases. And that, of course, caused interest rates to go up. And it can also cause stocks to go down, which could cause people to lose confidence in the market. And if we start to see people lose confidence in the market, that could also mean they lose confidence in the economy. And really, stocks need quantitative easing. I've put up there on the screen both the Federal Reserve's balance sheet and how they've expanded it through quantitative easing in blue, and then the stock market and how it's tracked that in red. And you can see that in general, whenever the Fed is creating assets and adding to their balance sheet, or as I drew there under no QE, just before QE2, when they hinted that they were going to start doing it, stocks tended to go up. And when they didn't, stocks tended to go down. Now you could see those blips under QE3 and QE4, which has shown an impressive run for the market. We did have some speed bumps in there, and those were the times where the Fed was just suggesting that they were going to start slowing down their asset purchases very soon. And so over the short term, into who knows how long into 2014, this will be the story to watch. Not only what it does to the stock market, but again, what it does to housing starts, because housing starts are going to remain the key, I believe, to whether or not we can keep hitting 3% plus economic growth. But if you take a step back and you say, well, are the Fed's policies really helping? And I think we will, for the most part, if you ask people on the street, 9 out of 10 would say the Fed's policies didn't help. I do seminars all around the country, and that's pretty much the consensus, is they feel it's not helping. And the reason it's not helping is there are some structural problems with our economy that are really hurting the potential for economic growth. First, let's look at this recovery and say, well, why in the world are you saying there are structural problems? What I did is I brought out one of my favorite indicators, and I call these recovery charts. And right now we're going to look at stock prices, but the way the recovery chart looks or works is the top band there is the very highest recovery we have going back to 1947. The bottom band is the very worst recovery we've had on record. The blue line there in the middle is the average, and then the red line is how that economic indicator is tracking. And you can see the stock market, almost this entire recovery has either been the best or almost the best recovery we've ever seen in stock prices. And so a lot of people would say, well, because of that, that should be helping the economy. And unfortunately, we haven't seen the growth in the stock market trickle down to everything else. If you want to look at employment, you would think employment would be strong if the stock market's doing well, but it really hasn't recovered much at all. This entire recovery has been tracking one of the worst recoveries on record. And what that has meant is that personal incomes have not gone up, because not only are we not seeing more jobs, but we've also seen the jobs that are being created not carry the same amount of wages that the old jobs that they're replacing have. So when you look at disposable personal income, you can see it's actually tracking the worst recovery we have on record. And the only time we've seen any encouraging signs there was that little blip back at the end of 2012, and that blip is really just it's really caused by Congress, because a lot of companies at the end of 2012 were paying special one-time dividends because they weren't sure, with the fiscal cliff hanging over them, what the tax policy was going to be for 2013 and beyond. So they paid out all these dividends, causing a bump in disposable income. And as you can see at the very end of that, we've seen disposable personal income once again slow down, and that's definitely a big problem, because we've seen stocks continue to grow throughout this quarter, yet income slowing down. So what all that's added up to is, on the one end, you have stock prices showing the very best recovery on record. Then you have jobs and personal income showing one of the worst recoveries, if not the worst. And that's added up to GDP growth, when you look at its recovery chart, show the worst recovery we've seen ever in terms of GDP growth. So So let's keep that in mind. We have the stock market showing the best year since 1997, the best recovery we've seen going back into the 1980s as far as stock price recovery goes. Yet, GDP growth is tracking the worst recovery on record. There's a big disconnect. And I think something that people don't understand is eventually stock prices track what the economy is doing. So unless the economy really picks up steam going forward, we're going to see stock prices have to adjust to the new reality. Stock prices, as I mentioned there in our leading economic update, they're showing growth of 3 to 5% actually going into this update. If you look at history, when stock prices have been up this month, we were in an economy that's growing 4% or more. Right now, from 2009 till the present, GDP growth has averaged 2.3%. It's the lowest GDP growth we've seen in any bull market. So that's something to really keep in mind. Another question I have is, does the 3.1% target rate that the Fed is using, that Congress uses, and that economists use as their normal GDP growth, does that make sense anymore? And one thing I did is I took a look at the 4-quarter average for GDP growth, and then I drew a linear trend of just to see where are we heading now. So the 3.1% average includes all those good periods of the 1940s and 50s, the good periods in the 60s, and of course the great periods in the 80s and 90s, where we were seeing very strong economic growth. But unfortunately, we don't have the same things in place that we had that caused the high growth back then. Number one, we were becoming an emerging star in the world economy as we came out of World War II, and then turned into this just industrial powerhouse. But then our growth in the 80s and 90s was mostly the result of cost cutting, a huge use of leverage and debt, and things to try to create growth. And what I called it then was artificial growth. We don't have any of that. We don't have these emerging economies anymore in our country to help spur growth. We also are not going to be able to use debt like we did before, because everybody around the world has had their day of reckoning, and there's so much debt out there that there's just not a willing group of people or investors that are willing to absorb all that debt. So the world's kind of reached this point where it needs to deleverage. So will we ever return to that? Is 2% going to be the new normal economic growth, or 3% or somewhere in between? I would guess over the long run, when we look back at this period, we'll start to say 2% growth became the norm until we deleveraged, until we found ways to bring American jobs back, until we found ways to have more things manufactured in the United States. It's going to be very tough to get that 3% growth. One other thing you can look at is just our manufacturing capacity. If you look at the utilization of our factories, you can see back in the 60s and 70s and even in the 80s, we had high 80s, almost up to 90% capacity utilization. Now, we're sitting below 80. And what that means is our factories are much less efficient. They're not producing as much as they were. So back when we had 4 or 5% economic growth, that was a result of very efficient factories. Now we've seen this trend down. Again, that dashed line is the linear downtrend. And we're just kind of meandering along. We aren't increasing the utilization of factories that are already built, which makes it much more difficult to get to 3% GDP growth. Another thing to look at is, how do consumers feel? And this is something that I don't see a lot of people talking about, is if you look at the Consumer Sentiment Index. Now what I like about when you ever use an index is you can compare today's value to past values. I circled some points on the chart. You could see back in the heydays, that just before the tech bubble burst, we were at 110 on this index. And even during the housing bubble, when it recovered, it hit a peak in 2004 just below 100. And then you could see the peak in 2007, just before the housing bubble burst, and then everything fell. Our rally back as far as how consumers feel about the economy is still below the bottom of the tech bubble. So consumers aren't as optimistic as they were, which means they're going to be a little bit tighter on their pocketbooks. They're not going to spend money like they used to, which again, just like capacity utilization, makes it more difficult to get to that 3.1% GDP growth. And it really shows up if you just look at consumer spending. Again, the dashed line is the linear trend, and you can see consumer spending is again slowing down. We're heading back to a consumer that's only willing to spend 2 or 3% more of their money each and every year, whereas before we were looking at 8, 9, 10% growth in consumer spending. Now there's a lot of reasons behind that, and maybe it will start to pick up again, but I doubt it. The two crashes that we saw have really changed consumer behavior, and again you go back to consumer sentiment, they're just not as optimistic as they were, which means they're going to be spending money at a much lower level. So when you add those things up, you look at just the normal trend in GDP growth, you look at our manufacturing capacity, you look at consumer spending, then you overlay the things like how much debt was used to create that growth, and will we be able to use that debt again? It really becomes a question of, are we going to be able to grow GDP above 3.1% for a very long period of time? Now if you listen to all the forecasts on Wall Street as we head into 2014, they're saying absolutely. They believe 2014 growth is going to be better than 2013, and I think it'll start out that way. The question though is, can the economy stand without the Federal Reserve? You know, without them creating money and boosting the bottom lines of the Wall Street banks, which then trickles into the stock market, where are we going to be once we don't have Fed stimulus in there? Are we going to be able to ever grow at 3% again? And I just don't know. But when you look at the forecast on Wall Street, it seems like everybody's saying, hey, get in, it's going to be another good year for the market. But I think people need to just take a step back and put this bull market in perspective. We will hit the 5-year anniversary of the bull market in the first quarter of 2014. Already, if you look at bull markets going back to 1928, we're looking at a bull market that's back to average. 57-month average, so as we go into December and January, we're going to be longer than the average bull market. Return-wise, we've also hit the average return for a bull market. So then you look at the top corner there and say, what's going to cause this bull market to last as long and to generate the returns that all those other past bull markets did that were better than that? And those dates should jump out at you. 1982 to 1987. Great time of growth for our economy. 1949 to 1956, another good time for our economy. And then of course 1990 to 2000, the longest bull market ever. What's going to cause this bull market to get into the growth that those saw? Now maybe economic growth will pick up. I think, again, at least going into the year, things look pretty strong. But I just have to say, if the stock market's showing the best recovery on record and the economy's not, something doesn't add up. I think we're seeing a disconnect between the haves and the have-nots, and that's going to continue to weigh on the stock market. So if you're a buy and hold investor, I would just say be cautious right now. And if you don't have money in the market right now, I'd wait. 165% return, and now you want to jump into the market? Just be patient. We will be talking during the first quarter. We'll try to get it on here, but if you're a client of ours or work with one of our investment advisor reps, we will be doing a round of seminars called Investing in a Rising Interest Rate Environment. I know a lot of people in bonds are really worried because Wall Street's telling them, hey, interest rates are going up, you got to get out of your bond funds. That means people that used to be invested in bonds would be jumping into the stock market. I would say be patient. Talk to us, talk to one of our representatives, and just say, is there a way to make money in a rising interest rate environment without taking on a great deal of risk? We will talk about all of that on our website. It's right up there on the screen, stratequity.com. Now there's going to be a whole lot of information on our website. The best way to gain access to that is click on the link, either professional or investor, depending on if you're in the business or if you're just an individual investor wanting to learn more. And after you do that, you'll get one communication from us, which is just an email. Always check your spam folder just in case, to confirm you're a real person. And after that, you enable your account, and you're free to browse around our website. Every day when I'm in the office, I'm going to create a blog, and it's going to be under that trading desk update. It'll show up on the right-hand side of your screen. I'll also post a weekly podcast where we recap the market. So if we do anything on interest rates, if we talk about what the Fed's doing, if we talk about our next economic update, it's all available right there. So if you found this information useful, I thank you for tuning in. I encourage you to share it on Facebook, Twitter, YouTube, whatever it is, get that information out there, because I feel like an educated investor, an educated voter, an educated consumer is much better off for our economy, and then we will get back to that place of strong economic growth. Until next quarter, again, I'm Jeff Hybiak, Portfolio Manager for Strategic Equity. Enjoy the rest of your year.